This is one of Warren Buffett's favorite stocks. Yes, it is the Coca Cola Company, ticker symbol KO. It is currently trading at $60.04 a share and pays a massive 3.06% dividend yield. What we're going to be doing today is looking at my automated stock valuation spreadsheet. Links are in the description. Looking at the discounted free cash flow model, the comparable company model, and finally the Ben Graham formula for intrinsic value to see if Coca-Cola is a buy or a sell. Now, as I said at the start of the video, it is one of Warren Buffett's favorite stocks. If we look at the top 50 holdings of Berkshire Hathaway, it is sitting at number 4 behind Apple, Bank of America, and American Express. He owns currently 22.4 billion of the stock, and I think it pays them around about $800 million a year in a dividend. So let's have a look at the share price. As I said at the start of the video, it is $60 a share, pretty flat year to date. Now, if we take this out over the last 5 years, it is actually up 21% in that time. From the bottom of the pandemic, it was $38 a share and is up 56% since then. If we were to compare this against the market, I think there's no surprises here. What we'll see, yes, the market has, over the last 5 years, beaten Coca-Cola 80% to 21. Now, if we take this from all time, click on the max, Coca-Cola is beating 5,600% compared to 1,000. Let's have a look at my spreadsheet here. So what we'll do is we'll type in ticker KO, and this will load up all the company financials. As I said before, please have a look at my Patreon. Links are in the description if you're interested in this sheet. So what it does, it'll load up all the company financials, $60 a share, 260 billion market cap, a P ratio of 24.4. And if we have a look at the market average right now, it is currently around about 26. So Coca-Cola is lower than the market average. Earnings per share, $2.48 a share, and has a beta of 0.6, which means it is a lot less volatile than the market. Shares outstanding 4.3 billion, and an analyst target price of $65.64. So analysts are saying the stock is a buy. As I said at the start of the video, it has a 3.04% dividend yield, which gets you about $1.83 a share. They pay out $8 billion in dividends a year, and a lot of that goes to Buffett, as we've seen. Payout ratio is pretty high, 73 and 77%, with an ex-dividend date of end of February if you want to own the stock. What I'll do is actually, I've got this dividend history chart which I've got for KO. This is since 2013. I could get more data, but basically it just shows the same pattern, which is Coca-Cola are constantly increasing their dividend. So at the start of 2013 it was 25 cents. Since then, it has doubled to about 46 cents per quarter, and they have no signs of stopping or slowing that dividend. So let's have a look at some of the company financials here. This is the revenue, which is the amount of money generated from the business, and yes, it is up over the last 5 years from 33 billion to 45, but it's still not as high it was back in 2013, 2011. So yes, it is in the right direction, but still not at its all-time highs. Now, as I said before, if we were to just have a look at the stock price over the last 5 years from 2013, you can see that the stock is a lot higher than it is now, but for a similar revenue. Next, we want to have a look at the net income. This is the profit, and obviously we want to see this increasing. And a very similar story since 2018, since the pandemic, the stock is up to about 10.77 billion. All-time highs over the last 12 years was back in 2010. So it had a bit of a downturn, but it has rebounded and pretty much up there with its highest profit all time. Next, you want to have a look at shares outstanding. Why do we care about this? Well, you want to see the company buying back the shares because it makes you as an investor, it's a way of bringing up the stock price. They can buy back the shares if they think it's undervalued, and then it rewards you as a shareholder because you own more of the shares. Now, there were some stock splits in here which have, I think, caused some trouble with the graph, but the main value we're looking at here is since the stock split of a 2-to-1 in 2011, and then it has decreased since then. We'll ignore this 2018 number here, but you can see it is steadily decreasing, although they have issued some more shares over the last few years. Assets versus liabilities, we can see it is quite high. 69 billion in liabilities compared to 23 billion in assets. And finally, the free cash flow. This is cash from operations minus capital expenditures. And what do they do with this free cash flow? Well, they can use it to allocate dividends, pay down debt, or grow the company. And it is currently at 10.17 billion. So one of the highest in recent years, but 2021 was the highest. So it has been increasing. This is what we like to see, but obviously not at its all-time highs. Now we want to have a look at discounted free cash flow model. This is the method of valuation that estimates investments using its expected future free cash flows. Let's take a look. So based on averages, which is the averages of the prior years, it actually gives a calculated stock price of $70.52 a share, which means it's a buy. Now let's have a look at some of these numbers here. First, we'll just have a look at what analysts are expecting in terms of revenue over the next couple of years. 45.5 and 47 billion. So that is, yeah, pretty fair to what we're saying. We'll just bring this down just a touch to make it in line with those estimates. We'll change that to 300%. That'd be very good. I meant we'll do 3%. So still a $69 stock. Next, we'll have a look at those net income margins. Net income margins are pretty consistent for Coke, so I think I'll keep that there. And also in the net income to free cash flow, in fact, you can see that it is increasing, so we'll be a bit more bullish on these numbers. Change this to 90%. And that puts it at a $76 stock. So discounted free cash flow does like the stock, but normally discounted free cash flow likes a company like Coca Cola, where they have quite a high free cash flow. Next, we'll look at the comparables companies model. What this is it's a process to evaluate the value of a company using the metrics of other businesses of similar size in the same industry. The values that we are looking at here are EBITDA, which is earnings before interest, taxes, depreciation, amortization, EV to revenue, EV to EBITDA, and PE, which is the PE ratio. So if I go to Yahoo again, it'll give us some examples of some comparable companies. Let me go, I believe it shows you on the financials page. Let me just quickly go to here. Oh no, well, I have a couple in my mind that I want to check, which is obviously Pepsi, and okay, it's not doing it. Oh well, thanks Yahoo Finance. Normally it does it. Well, luckily I do have the stock tickers in my head. So Pepsi is PEP. Then we want to look at Monster, which is Monster Energy, and that is MNST. And then the final one is Keurig Dr. Pepper, which I believe is KDB share price. KDP, sorry. So KDP. And there you go. So now this will load the financials for those companies so we can now compare. So having a look at the, if you look at equity value as well, you can see that Coke and Pepsi are the closest, and then Monster and Keurig are kind of a bit behind there, but I want to use them as comparison. So EV to revenue, Coke is higher than the average. It is lower than Monster, but higher than Pepsi and Keurig, Dr. Pepper. EV to EBITDA, it is one of the lowest, and PE ratio, it is one of the lowest. So if we look at the implied value, 46 for EV to revenue, 57 or 58 for EV to EBITDA, and P 70. As an average, that brings it down to about 58. So what I'm going to do actually is compare it to its closest direct competitor, which is Pepsi. 40, 51, and 66, which is a buy price of 52.55. So it is a little bit overvalued in terms of the comparables company model. If you compare it to multiple, yes, it is still slightly overvalued, but compared to Pepsi directly, $52 a share. Suppose give a comment down below if you want me to have a look at Pepsi a little bit more in detail. I think on comparable companies, it might be slightly undervalued based on these numbers here. Next, we want to have a look at the Ben Graham formula for value, or for intrinsic value. This Ben Graham was the father of value investing, and what we do is this is looking for the growth over the next 7 to 10 years. We have the earnings per share, the P base of a no growth company, expected growth rate from 7 to 10 years of earnings per share, and then the average AAA bond yield divided by the AAA on corporate bonds. So let's have a look at what analysts are saying for the growth of Coca Cola. 6.34, so we'll add that in there, 6.34, and obviously bond yield, we already looked at this, but it was 4.87, and grain price of $30 a share. So Ben Graham does not like Coca Cola. Very interesting. But yeah, even if we look at the last 5 years, which was 7.33, that is still a $30 stock. So for Ben Graham to be interested at this stock, it would have to be an expected growth rate of 20%, which Coke is probably not doing anytime soon. So Graham's model says it's not a buy, comparable company model says it's about fairly valued, and discounted free cash flow model says it is a buy. So if you're interested in this for its dividend, then obviously, you know, if you want to buy it, but it seems that the models are saying this is about fairly valued. And if we look at the revenues and net income, it isn't really growing at a fast enough rate to justify its current prices. Right guys, thanks for watching. Please give a like on the video if you enjoyed it, subscribe if you're not already, and I'll catch you guys next time.